Hi, I'm John Mark Young, President and Chief Investment Officer of Whitaker-Myers Wealth Managers. And today we want to talk to you about a very important topic based on what the market's doing right now, dollar cost averaging. With how the market has performed, now is a great time to touch on this topic. Dollar cost averaging is an investment strategy that utilizes consistency to systematically invest equal amounts despite what the state of the market might be today. Now think about your 401k plan. What happens with that? Well, every 2 weeks or twice a month, you're paid from your employer, and they, your employer at that time, take out a little bit from your paycheck, and hopefully you're also contributing some dollars to your Roth IRA as part of your baby step 4, all totaling about 15% of your income. And this dollar amount is then deposited and invested into your 401k and Roth IRA, regardless of what the stock market's doing. Meaning that if the stock market's down 25%, like it is this year, you just deposited and bought stocks 25% cheaper than you were able to do earlier in the year, thus bringing down the total cost to invest. And we know that looking at the stock market, it's been positive 80% of the time over the last 20 years. But did you know that 95% of all years, there's a decline of at least 5%? If you're dollar cost averaging, meaning saving money in regular intervals on set time periods, you'll be able to take advantage of those 5% drops, which are happening in years when the stock market is negative and positive. Listen, volatility is the thing that is guaranteed. So you have to learn how to take advantage of that over your working career. Now, dollar cost averaging helps eliminate the potential risk of human error that comes with trying to time the market with making a one-time lump sum deposit. This strategy will help you neutralize short-term volatility in the broader equity markets, as well as building your wealth and saving in the long run. When trying to outthink the market, some investors may make counterproductive decisions that do the exact opposite of what they actually want to do. These decisions can be bred out of the many emotions like fear or greed. An example would be panic selling when they see prices decline or buying too much when prices are rising. Look, Warren Buffett tells us buy low and sell high. However, data suggests that most investors buy high and sell low. Ouch! Dollar cost averaging helps remove your greatest hindrance, your emotions. This year has been rough for the market, which has made it a very emotional year for investors. Many people want to find out what the next big stock is to make money, or possibly try to outthink the market to maximize their gain against everyone else's losses. Well, dollar cost averaging is just a great investment strategy when dealing with bear markets like we're currently in. It helps keep you invested and on track with the market on a regular basis, because when the market's down, you'll buy more shares and less when it's up. Your returns will be amplified than if you were just pulled out of the market and were down. Eventually, market stability will return to normal, meaning consistency that you put in, the consistency you have today, will power your future long-term returns. Now let's look at a quick example, a Ben and Arthur example from 2018 that's on our website right now. It's an article titled "Thankful for a Bear Market, Maybe You Should Be." And we took the Ben and Arthur example that Dave Ramsey uses in Financial Peace University. And in that example, they said, hey, Ben, who saved earlier in his career, had more money than Arthur, who waited to save and had to save a whole lot more. What we looked at was Ben and Arthur in the same year, 2018. Ben started in January and Arthur started in December. Now, you would think that Ben probably should have done better, right? He started in January. But actually in 2018, Arthur, who started in December, did better. Why? Because in 2018, we had a stock market that at the end of the year dropped 20%. And on Christmas Eve, I remember sitting there with my family on Christmas Eve thinking, oh goodness, 20% down for the market. But that was the worst of it. And then we bounced from there. So Arthur, who put his money in at the end of that year, actually today has 20% more than Ben. They both have made money since then, but Arthur has a little bit more. Dollar cost averaging, putting money in regular intervals when the market's down, can be your best friend. Now, call us today. Go to our website, Whitaker Wealth, which can be found in the notes of this video, to talk to an advisor to make sure you're executing your baby step 4. And for those of you that are not Dave Ramsey people, that's just saving 15% of your income into retirement in regular intervals. But talk to one of our advisors who can help make sure that you can get. And hey, the best thing about Whitaker-Myers is no minimum account size. So you need to start doing this from the ground up, from $0. We're happy to help you. We have advisors that would be more than willing to sit down, look at that, do a financial plan for you, and go from there.